All right, before we get started with this video, which actually I'm shooting this at the end of the video, I want you to like, comment, share, and subscribe to this channel. Hit the little bell thing at the bottom, that way you get a notification every time I post a new video, which is every Sunday at 5 p.m. Eastern Time, which is subject to change come football season. Please comment what times you think the new time should be, and let's get right into it. What is going on, YouTube? Welcome to another episode of Money with Manny 101. On this episode, we are going to cover how to budget my paychecks with a special twist of while in debt. Now, if you're not in debt, don't worry about it. There's still going to be great information that you could use and actually grow your wealth. Because I personally am still in debt, and I'm paying that off fast while still being able to live the way I live. I was still able to purchase the beautiful house that I'm actually shooting at right now while I'm still paying off debt and still raising my credit score. So essentially, this is a look of how I personally go about budgeting my paycheck. To get started, the first things you want to take care of is your pre-tax. I don't even want to get to when the check hits your bank account. I want to tackle it before it even gets to that level. The pre-tax is what we call retirement. I want you to take care of your future because nobody else will. Whether you're married with kids or you're single, the most important thing you can do is invest in your future. What you want to do is put pre-tax money into a retirement account, whether that be a 401k, a 403b, or a TSP if you're in the Army, or BRS, whatever it might be. Whatever that looks like is what I want you to do. Now, as a minimum, what I would say is to do your employer match. The employer normally goes with about, I've never seen anything more than 6%, but it's usually between 2% and 6%, where they say if you put 2%, we'll match you 2%. I want you to maximize that number. If they say they're matching 6%, guess what? I want you to put pre-tax 6%. As a minimum, I want you to do the employer match. If the employer doesn't have a match, my recommended percentage is 10 to 20. I don't want you to do 5. That is cheaping out on your future. I want you to do 10 to 20. Right now, I'm still paying off debt, and I put 10% of all of my income towards my retirement. This is pre-tax. Now let's get to the actual check. Now the check has hit your bank account, and just to keep tally, let's say you get paid on a bi-weekly or semi-monthly. You get paid on every 1st and every 15th, which is how I get paid. And let's just, to keep numbers round, say every check you get $2,000. Okay? It's a beautiful day. It's the 1st of the month, and you just got $2,000. And now you're looking at yourself, and you're like, what do I do with this $2,000? Now, the first thing you should always do, now that you're already taking care of your future and you have nothing to worry about when it comes to your future, is take care of your savings or investing. This is called paying yourself first. I always keep that number at 10%. This creates good habits, and this teaches you how to keep money away and always take care of you. Because whether you made $2,000 this month or $1,900 this month or this check, you will still have to pay your bills with whatever is left. That, while in debt, should only be for savings. I say saving because I look at it as an emergency fund. An emergency fund is essentially a money for a rainy day, which is why your emergency fund should always be your highest, or your highest copay. So if you have a home and you have insurance on the home, and they tell you that if the house happens to burn down, for us to rebuild this house, you will need $2,000 cash. Your emergency fund should be $2,000. So with that being said, that will be 10% until I build that up. The reason why I say until I build that up is because once it is built up and I have my $2,000 of saving, and something happens where I have an emergency where I need to fix my truck, let's say it costs me $500. Now I go back to that 10% and I start rebuilding my emergency fund until it hits that $2,000 or whatever it might be. Now, with that being said, 10% of my $2,000 is going to be $200. So now I already took $200 out of this check, And now we have $1,800 left to take care of the rest of the things you gotta take care of. This $200 is going towards the emergency fund. All right, now that $1,800, what is next that we take care of is our bills. Everything that comes every month, whether we like it or not, we gotta pay it. Those are called bills, and we all know what they are, because if you don't pay it, the bill collector is gonna be ringing your phone, and it's not gonna say scam likely. With that being said, there are two types of bills. There are fixed bills and there are variable bills. Your job while you're watching this video or after you're watching this video is to figure out every bill that you have. I want you to go back through your bank statements. I know it's hard to do. Go back through your last month's bank statement and figure out every single bill that you have, including your Apple Pay or your Apple Music, or if you have Spotify, YouTube, Premium, whatever it might be, the smallest amount. I want you to figure out what that is, whether it's a fixed amount or a variable amount. A fixed amount means it's the same every month. A variable amount means it's different, like your electric bill. That comes based on usage. Your water bill comes based on usage, and it's a quarterly type of thing. Now, with that being said, you should know the exact amount that you're paying for bills every month, and your bills and your expenses should always be less than what you make. So if I'm making $4,000 in a month, my bills and expenses should be less than $4,000. With that being said, let's say that I personally know my bills, and on the first of every month, my bills comes out to, let's say, $900 total. So now I take care of my $900. I know that out of my $1,800, $900 of it is going to be for my bills, whether they come out on the 2nd, the 7th, between the 1st and the 14th. Anything that comes out is going to total $900. So out of my $1,800, I know that $900 is going to go towards my bills. This leaves me with $900 to take care of the rest of the things that I have. Now, like I said, this $900 is my bills. Doesn't matter whether it's fixed or variables, they add up to $900. And this is just to keep numbers right. I know that my expenses over the next 2 weeks is gonna cost me about $300. So that comes here, and I know it's gonna cost me $300 to get gas in the next 2 weeks, to get groceries, $150, $50 for gas, maintenance, whatever it might be. So now, out of my $2,000 check, I only have $600 left. So that $300 is my expense. Okay, so now we have $600 left. With that $600, the next thing I want to do is to use a percentage of it to pay down debt. I've taken care of my savings and paying myself first. After I've taken care of my bills, after I've taken care of all my expenses, I use 50% of the remaining amount to pay off debt. The reason why I did that is because I personally think that debt is what keeps you in chains. I feel like if you pay off your debt, you are a free person. But 50% of that $600 is going towards paying off debt. So $300 out of the $600 is gonna go to paying off debt. This $300 is going towards paying down debt. Now we have $300 left. The last thing you take care of will be your wants, but you're not using the whole $300. You want to use a percentage towards your wants. But it should not exceed 10% of your check. Now, let's say this was only $100 left. You would only take 50% of that, $50, towards your wants. But since this is more than 10%, you can use up to $200 on your wants because you have that remaining $300. No more than 10% of your actual check should go towards your wants. So with that being said, with that $300, it should be less than or equal to 10%. So then I would have $200 maximum going towards my want. Now that will leave you with $100 buffer between now and your next check. That essentially covers how I go about using my checks. Now with that being said, your bills breakdown. This is the most important thing. This is when you're reviewing all your bills and you're reviewing your monthly statements. I personally get paid on the 1st and the 15th of the month. So I break my bills down between the 1st and the 14th, and then the 15th and whatever the last day of the month is. And that lets me know how much I have to spend each check on my bills. And same thing with expenses. I look at my bank statements and I don't average it out because it could be more than that average. I always take the most amount I've ever paid for something. So if my electric bill has been at $300 before, my budget for my electric bill will be $300. All right, and that concludes your bills breakdown. Now, these are my must-dos and my 5 golden rules. Rule number 1, if it's more than $500, if the bill is more than $500, the expense is more than $500, split it. I understand it happens every month, but I would still split it into 2 at least. I'll take $250 from the first check, $250 from the second check, and that is how I come up with that $500. So I never pay $1,000 for my rent or mortgage. I pay $500 a check. Must do number 2, save 10% of all income. I cannot emphasize how important this is. Like, everything that comes in, save 10%. It creates a beautiful habit. That way, even when you're debt free, you know to save. Must do number 3, budget what you know. So budget your 40-hour work week or your 25-hour work week. Budget your salary. Budget the income that you know is coming in. That way, any money on top of it, you could apply the 10% saving, you could apply the 50% towards debt, and you could apply the less than 10% towards whatever it is that you want. Must do number 4, be in the know. It's very important to know where you are. I can't emphasize that enough. I want you to know how much you owe down to the penny. Budgeting does nothing for you if you don't know where you are, if you don't know where you stand, and if you don't know where you're going. Budgeting essentially is just a roadmap to get to where you need to be. And then step number 5 is to anticipate your life changes. Anticipate what is going to happen. If you plan on quitting your job, anticipate it. Maybe that means you don't put that 50% towards paying down debt, and you take that 50% and you go back up here and you put it towards your emergency fund. That way you have some type of buffer while you're looking for a new job. Or even better, find a new job before you quit the old one. That way you can put a 2 weeks notice and you can let your new job know, hey, this is my 2 weeks notice from my last job and I'm going to start this job on this day. That way you have the continuous income. And whether it be a bump up or a bump down, if you anticipate the change, you can continue to budget properly. And as long as you continue to keep your income above your expenses, you should always have a positive cash flow. This here is exactly how I take care of my finances. Now, what might work for me and the next person might not work for you. And I want you to understand that everything I say should be taken with a grain of salt, and that you should apply your own twists to everything that is listed here and everything that I have talked about during this video, so that you can hopefully find yourself in a better financial situation. All right, family, so if you've made it all the way through, congratulations. I hope that you learned something, and if you did not, please pass the video along to somebody that might. I want you to like, comment, share, and subscribe to this channel. Hit the little bell thing at the bottom. That way you get a notification every time I post a new video, which is every Sunday at 5 p.m.